Top 10 Mistakes New Bitcoin Investors Make. Bitcoin has captured global attention as a revolutionary digital asset, offering a decentralized, borderless, and potentially lucrative form of investment. However, as interest surges, so does the risk, especially for new investors. Many newcomers dive headfirst into Bitcoin without understanding the underlying technology, market behavior, or proper risk management. Before we get started, subscribe to our channel and turn on the notification bell so you never miss our latest content. 1. Investing without research. New Bitcoin investors often make the mistake of jumping in based on hype rather than understanding what they're buying. Bitcoin isn't just another stock, it's a completely new asset class powered by blockchain technology. Yet many beginners treat it like a lottery ticket or meme stock, thinking its price only goes up. This can lead to uninformed decisions, overconfidence, and eventually losses when the market corrects. They may not understand concepts like private keys, wallets, transaction fees, or how block rewards and halving events affect supply. Ignoring these fundamentals increases the risk of panic selling during dips or falling for sensational headlines. Bitcoin operates in a volatile and often misunderstood market, and failing to understand the basics leaves investors vulnerable to emotional and irrational decisions. Education is not optional. It's the first step toward long-term success in crypto investing. 2. Timing the market. Trying to time the perfect entry or exit is a common pitfall for new Bitcoin investors. The volatility of Bitcoin prices lures investors into believing they can buy low and sell high consistently. However, market timing is notoriously difficult, even for professional traders. Many beginners panic buy during rallies or sell during dips, often doing the opposite of what they intended. This behavior results in losses or missed opportunities. Emotional decisions, fueled by fear of missing out, FOMO, or fear, uncertainty, and doubt, FUD, often override logic. Long-term data shows that those who simply hold, or HODL, over multiple years tend to outperform those trying to outguess the market. Reacting to short-term price action rather than having a strategy often leads to failure. 3. Ignoring risk management. Bitcoin's extreme price fluctuations can lead to large gains, but also steep losses. New investors often ignore risk management and invest more than they can afford to lose. Bitcoin has seen corrections of over 80% multiple times. Without proper position sizing and an understanding of risk tolerance, even small price moves can result in sleepless nights or panic selling. Risk management also includes understanding how to diversify and allocate across different asset classes to protect against a total portfolio collapse. Ignoring this principle can quickly turn Bitcoin investing from exciting to catastrophic. 4. Falling for scams and fake promises. Crypto is fertile ground for scams, and new investors are often the easiest targets. Fake investment platforms, giveaway scams, Ponzi schemes, and impersonators promising guaranteed returns are rampant in the crypto world. Scammers often pose as celebrities or influencers, using fake screenshots, YouTube videos, or social media accounts to gain trust. Once funds are sent, they're usually impossible to recover. Even seemingly legitimate projects or platforms can rug pull investors. The decentralized nature of crypto means there's little recourse if something goes wrong. Without due diligence, new investors can fall prey to promises of doubling your Bitcoin or safe returns that are too good to be true. 5. Keeping Bitcoin on exchanges long term. One of the most critical mistakes is storing Bitcoin on centralized exchanges indefinitely. While exchanges offer convenience, they are also high-value targets for hackers. Several major exchanges have been hacked in the past, leading to billions in losses. If you don't control the private keys, you don't fully own your Bitcoin. Additionally, governments could shut down or regulate exchanges overnight, freezing your funds. Exchanges can also go bankrupt or experience technical issues, locking investors out of their assets. Long-term holders should always take custody of their crypto using secure wallets, preferably hardware wallets that are offline and immune to online attacks. 6. Overleveraging with margin or futures. Some new investors get enticed by the idea of multiplying their gains using leverage. Crypto exchanges often offer 10x, 50x, or even 100x leverage on Bitcoin trades. But what's often not understood is that leverage cuts both ways. Gains may be amplified, but so are losses. A small price dip can liquidate an entire leveraged position. Margin calls are common in volatile markets like Bitcoin, where a single hourly candle can wipe out positions. Overleveraging is not investing, it's high-stakes gambling. Many have been wiped out entirely because they misunderstood how fast things can go south in leveraged trading environments. 7. Obsessing over short-term price movements. It's natural to want to check prices constantly after investing, but this can become a toxic habit. Many new Bitcoin investors refresh their apps every few minutes, stressing over every small move. This creates anxiety, emotional instability, and often leads to impulsive decisions. Bitcoin is volatile by nature. In a single week, it can swing up or down by 10 to 20%. Successful investors don't panic over red days, they plan for years, not hours. If you're glued to the screen, it's easy to lose sight of long-term trends and make poor decisions based on noise rather than signals. 8. Blindly following influencers or friends. Just because someone on TikTok or YouTube claims Bitcoin will hit $1 million doesn't make it true. Many new investors follow the advice of influencers, celebrities, or even friends without verifying the information. Some influencers are paid to promote certain coins or platforms and may not disclose conflicts of interest. Others may genuinely believe in Bitcoin, but their risk tolerance or timeline could be very different from yours. 9. Ignoring tax implications. Many Bitcoin investors don't realize that buying, selling, or even swapping Bitcoin has tax consequences in many countries. Capital gains tax can apply when you profit from selling Bitcoin, and losses may or may not be deductible depending on your jurisdiction. Failing to report crypto income can lead to audits, penalties, or worse. Additionally, frequent trading without tax planning can complicate your return or inflate your tax bill. 10. Thinking Bitcoin will make you rich overnight. The media often showcases Bitcoin millionaires who got in early and made a fortune. This fuels the misconception that Bitcoin is a get-rich-quick scheme. In reality, those success stories usually involve years of holding, extreme discipline, and high risk tolerance. Chasing overnight riches often leads new investors to overextend themselves or fall for scams. If you enjoyed this video, give it a thumbs up and subscribe for more content. Hit the notification bell to stay updated with our latest videos. Share your thoughts in the comments below. Thank you for watching.